Welcome to lecture 3. In today's lecture, we're going to look at, um, continue rather, our introduction that we started in the second lecture, which is to introduction to double entry bookkeeping. And on this segment, we're going to look at the balance sheet and the effects of the balance sheet to the business transaction. Okay. Now, the accounting equation, we looked at the accounting equation in our last lecture, uh, which is expressed in a financial position statement called the balance sheet. Now, everything that you represent in the equation, accounting equation, like I said in the last lecture, that it is a very, very important lecture. I mean, it is a very important equation that we'll be talking about from now till we till we proceed until we conclude this program. Okay, now the equation whose results are represented in the balance sheet is a very, very unique and a very important factor in our study. Now, the balance sheet shows the financial position of an organization at a point in time. Okay. In other words, we are saying it represents or it presents a snapshot of the organization at the date for which it was prepared. Now, the balance sheet is not the first accounting record to be made, nor the first that you will learn how to do, but it is a convenient place to start considering accounting. Okay, now, because of that, let us now look at how a series of transactions affect the balance sheet, shall we? Now, introduction of a capital. Now, first of all, we know that a business, we indicated in our last lectures that capital is something that is very, very important to a business. Now, imagine you put this capital into a business. We are having a case. Therefore, today we are looking at this case. Now, I want you to follow me through and and concentrate, because in what we're going to be dealing with today, we're going to be dealing with something that is very, very simple, but a bit technical, in the sense that if you miss it out, you're going to fail to follow through as we head to something that is a bit complex. Now, let's look at the business of Mkabwe. Okay. Now, on the 1st of May, okay, that is 2 by 7. Okay, that is just like uh, the representation of the period. Okay, the financial period. Mkabwe started a business. Okay, and deposited $60,000 into bank and into the bank account, okay, which was opened for the business. Now let's look at how it's going to be done. Now, if you have that amount that is you start with as a capital, when you take that amount to the balance sheet will show the date at which that was done. Then it will show the asset. Okay, so the asset, we're saying the asset, and we said asset, we've got the current asset and fixed assets. Now, current asset, part of the current asset is what? The cash. Now, we're saying our asset in this case is 60,000. Okay, you're going to understand what the CR later mean, but in this sense, this is just supposed to be like a dollar. Okay, you can just put dollar. So this represents amount in dollar. Okay, later on, you're going to understand what credit mean, which is CR. Okay, it means credit in this case. Okay, then we've got a capital, which is 60 $1,000. Okay, now at this point we have a basis where we have no argument. So we've got assets, our assets equal to $60,000, our capital equal to $60,000. Now at this point everything is equal, everything is the same. Now note how the top part of the balance sheet contains the asset and the bottom part contains the capital. This is always the way the information is presented in a balance sheet. Now remember, in a balance sheet, capital is supposed to be on the bottom of the entry. Okay, but the capital is supposed to be always on the bottom of the entry. Now we're going to understand how then it is going to be expanded in our next slides. Now, Let's look at now. That was, we were looking at the case where you start as a business. That is the first thing that you do as a business owner. Okay, you start with the amount, then in the balance sheet it is represented. Now, once a business begins to function, once a business begins to engage in other businesses, let's look at the purchase of an asset by check. Now, on the 3rd May, now after 2 days, 3rd May, this business by Kavwe, buys a small shop. Okay. Now, out of that $60,000, we remove $32,000 to buy a shop. Okay. Now we buy a shop where we're going to be doing our business. Okay. Now that business that business pays a check. Okay. Now the effect of this transaction on the balance sheet is that the cash at the bank is decreased and the new asset building is added. Okay. Now you've removed that amount of money. You've removed that amount of cash from using a check, and that amount has been what? Has been deducted from the bank. You buy a shop where you want to be operating as a business. So we have assets. Look at now how it has changed. Assets, okay, we've got assets which is in dollars. So we've bought a shop. Okay, a shop is part of our asset, which is $32,000. Then cash at bank. Okay, meaning that at the bank we are remaining with what? $28,000. Now our total is now 60, is still remaining 60,000. Okay, why? Because part of that amount, part of that current asset has been converted to a fixed asset, which is now which is still amounting to $60. Okay, I'm sure that is very, very simple for you to understand, because the 60,000 we was in current asset, now it has been converted into what? A fixed asset by 32,000 dollars. So we've removed the $32,000, which has been converted into a fixed asset by buying a shop. Okay, now that buying a shop is something that will be in fixed form, fixed shape, okay, as well as fixed volume, as scientists would say. Okay, now capital. Okay, our capital still remaining $60,000. Now, note how the two parts of the balance sheet balance. Okay, now have you seen how they are balancing now? Okay, that is, their totals are the same. Okay, this is always the case with the balance sheet. This is always the case in the balance sheet. Of course, as we go later, you'll be presented with very some complex works, but a basis for your understanding at this point is that it is always the case. This is supposed to balance to ensure that your business is doing well. Okay, unless you start making losses and things go wayward, we're going to know how that is done later. Okay, now after buying that shop, we're saying, oh, okay, now let's look at the purchase of an asset and the incurring of the liability. Now, as a business, once you purchase that thing, that property, let's look at now incurring, how we incur the liability, how we begin to pay out. Okay, now on the 6th of May, after 3 days, okay, of the business, Kawe buys some goods for $7,000 from Micah. Okay, and agrees to pay for them sometime within the next 2 weeks. Okay, meaning that Kabe buys goods from Micah. He buys goods from Micah, you know, on credit. Okay, we looked at credit in our previous lectures. Okay, where he has to be paying in 2 weeks' time. Okay, now the effect of this is that a new asset stock of goods is required and the liability of the goods is created. Now, a person to whom money is owed for goods is known as in accounting language is known as a creditor. Okay, in accounting terms, a creditor, we're saying, is a person, an institution, or or a firm who who whom the business is owing. Okay, now somebody comes, give us the money, okay, or give us whatever they are giving us, which is valuable to our business, and you see, those people are going to be called creditors because they are part of the people that are supporting our business, okay, to maintain its what? Objective. Okay, now let's look at how that will be now. So our assets remain what remain in dollars. Then where asset has been converted now. So now part of our asset, we've actually gotten, you remember where the 32,000 is coming from. Now that stock, okay, the goods has been added, which is the $7,000. Okay, $7,000 has been added. Then the cash at bank still remains, because remember, this amount we've gotten is is out of the amount we've gotten is on credit. Okay, so we're paying it later. Because we haven't yet paid it, we are remaining with what? See, we are going to remaining with we are going to remain with 28,000 at the bank. Okay, now when you add that, it means that on our total of the capital, we are adding a seven we're adding a $7,000 on our total. Now, so in the actual sense, our capital has more like increased because we've credited some money. Okay, we've gotten some money on credit. Okay, so that's why you can see there our total becomes 67,000. Okay, $67,000, or because we've credited some money and our capital has increased. Okay, now one thing that you need to ask yourself is, why then is that $7,000 in brackets? Okay, now there we're saying creditors. Okay, now a creditor, we're saying minus 7, because that person we are crediting, we are giving that amount is not original ours, we have to pay it back. So it is in brackets because it is less. Okay, so in accounts, anything that is in brackets is less the amount. Okay, anything in brackets is less the amount. So we are saying that amount less, then we're going to have what? You are going to land at the capital, which is $60,000. Okay, and our capital, as usual, like we said, it has to be on the bottom always. Our capital comes there as $60. Okay, now not how the liability, okay, or how the liability, we know that liability is the amount that the business is owing to others. Okay, so the liability in this sense is the creditor. Okay, is shown as the deduction from the asset. So now we have seen how it is shown as a deduction. This is exactly the same calculation as presented in most common form of accounting equation. Now we all know, we looked at by now we know that accounting equation is um, is given by, you know asset or capital is equals to net assets. Okay, is equal to net asset. Okay, now net asset is supposed to be found by asset minus what? Liability. Okay, so we are saying asset minus liability, meaning that the total assets we are minusing, or we are removing the liability. That's what we did here. Okay, so even if you use the formula, you still land at the same answer. You still land at the same calculation. Okay, now if you've got any questions, please be able to submit them on the comment section, and I'll be able to answer them once I'm able to see them. Okay, now that was the case. Now let's look at another case. Now the business is now in progress. Okay, now let's look at now the sale of assets on credit. Okay, now on 10th May, then after 10 days in operation. Okay, okay, Kabwe and his business. Okay, goods which cost sells goods which cost 60,000 were sold. Okay, or 600 dollars were sold to A plus. Now A plus came, so okay, we want to buy your products, and A plus was sold goods worth $600. Okay, for the same amount, the money to be paid for the same amount, which is supposed to be what? Paid later. Okay, now this was sold on credit. A plus came and said, no, I want goods, I will pay you back later. Okay, now the effect in the is a reduction in the stock of goods and the creation of what? New asset. Now let's see how it plays out. Now a person, of course, as we see the how it plays out, a person who owes the business money is known as a debtor. Okay, so a business has got two players, which is a debtor and a creditor. Okay, so you should not be getting confused when you going forward when you hear me saying creditor, debtor. These are points that I'll be using, concepts that I'll be using. I'll be using. I'm sure you will not be having challenges because I've explained them now. Now let's look at how that plays if we sell on goods, on credit. Now it has expanded. Okay. Asset, of course, we've got our shop there. Then stock of goods, we've got 6,400. Okay. Now 6,400, then 6,400. Now we have what? We have a data who is now on board. Okay. Now that data is the 600. Okay, and as usual we've got 28,000, which is just at the bank for now. We haven't withdrawn that money yet. Okay, because we've gotten goods on credit and we are giving goods on credit. Okay, meaning in the actual sense, meaning that we have not yet paid that person their money. Okay, and we have not paid our creditor their money yet, and now a person has come to our business to what? To get the money. Okay, so as you can see, we've got 70, as usual, the 65. Now that's 65, the balance, like we looked at in our last episode. Okay, as we looked at in our last episode, and we still landed at 60. Okay, now look at how a data is represented in this sense. That's my interest. Look at how a data is represented. Okay, so meaning that a 600 there, $600 indicated, uh, has been put there. Okay, all right. Now let's look at how a sale of immediate assets is with the immediate payment is shown. Okay, now this person comes. Okay, say no, I want to buy, I want to buy goods. I want to buy goods on your company. I'm sure by now you should be asking yourself, say, but then there is a 60, a 60, a 6,400. Where is that 400 coming from? Okay, which is covered here. Now this person has come. Okay, this person has come to our business. Okay, on the 13th. Now 3 days later, after 10 days. Okay, so after 13 days, okay, we are selling goods at $400. Okay, to Maleni. Maleni has come to our business and said, no, you people, I want to buy goods on cash. Okay, now this Malen guy paid, for immediately paid with via check. He paid through check, and here one asset, okay, the stock of good is directly reduced, while another asset, cash at bank, is increased. Now this person pays directly through, check. Now you see how it has gone, meaning that at our bank the money is what increased to 2,800, and from the stock we are reducing, meaning that from the stock we are reducing a 400. Okay, from the stock we're reducing 400. Why? Because it's just like a transfer. Okay, the money has been reduced from one form to the other, meaning that from our cash at bank it has increased, whilst from the stock of goods it has reduced. Now every business, that's what happens. Okay, you order goods today, those your money will be in form of goods. When a person comes to buy, you are transferring that amount into cash. Okay, so meaning that from the goods the money has reduced, then from the bank the money has increased. That is a very, very basic and simple understanding that you as a financial accountant need to be able to understand. Okay, now creditor. Okay, now creditor still remains. Remember, we've not paid that $7,000. Okay, so meaning we're still lessening. Okay, we're still lessening our capital. Okay, by $7,000. Okay, so but when you do that, still we're going to land to $60,000 as our capital. Okay, I'm sure that is a very simple understanding now. Okay, now let's look at another case of liability. Okay, now 15 days later, Kabwe pays a check for, 300. okay, $3,000 to Micah. He said, no, I'm owing this Micah guy. Let me give them some money, okay? And Kabwe pays $3,000, $3,000 to Micah. Okay, now meaning that they are reducing the credit to how much? 400. That's right, also. Okay, 400,000. Okay, out of that seven. Okay, now meaning that they are paying that amount they are owing. Now the asset of cash at bank is therefore reduced. Okay, now the asset of cash at the bank is therefore reduced, and the liability to the creditor is also reduced. Now, as we see now, if we pay back that 3,000, we're going to remain with we're going to remain, the man has reduced, which is 25,400, okay, at the bank. Then, which in total we're going to have 64,000, okay. Then, meaning that our creditor now has, like I said, it has remained with what? $4,000, okay. Now, total will still land us at 4,000, $60,000, and our capital still remains 60,000 dollars. Now, note how the total of each part of the balance sheet has not changed. Okay, the business is still worth $60,000 to the owner. Okay, nothing has changed. Okay, such that what still remains, the fact is that at this point we are having a cash at bank of 25,400. Okay, and the total of our business is 64,000. Okay, then the creditor, meaning that that other 4,000 is not ours. Okay, but the business still has 60,000 as capital. Okay, that is a very simple understanding. Now, once you collect assets, okay, A plus now who owes Kabwe, this guy who owes Kabwe comes, say, okay, um, you guys, I'm owing you $600. Okay, then I'm going to make a payment of $2,000 via a check. Okay, now look at how that is going to be done. We've got asset 32,000, then which is the shop, then stock of 6,000, then we've got the data, that amount. Now the amount has increased because they've given us that $200. That amount has increased. Okay, that amount has increased in the sense that now, instead of in our last discussion, we had we had 25,400. Now we've got 25,600. Okay. Now, when you look at that, you still see that 64,000. That's our total, and the creditor still remains a 4,000, and our total amount will still remain 60,000, 60,000. Okay. Now, I hope you are able to see how each one of them is coming to, to make sense. Okay. However, I understand that to some people, or to some students, this may seem to be a bit complex. However, do not worry. Okay. In our next lecture, you'll be able to understand exactly how this plays out. Okay. So I'll see you in the next session, where we'll be looking at we'll continue looking at this. But for now, I want you to digest this. Make sure subscribe, and share if you want, and also keep the video so that you can repeat it whenever you don't understand. For any questions, you can easily email me or inbox me or comment on the section or comment section. Okay, see you in the next lecture. Have a blessed uh, 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 have a blessed day. Thank you.